On June 12, 2026, SpaceX went public in the largest IPO in history, raising $75 billion and closing its first day of trading up 19%, at a valuation of roughly $2.2 trillion. Elon Musk became the world's first trillionaire that same afternoon. Here's the number that should stop you before you decide that means everything at SpaceX is working. On August 3, 2026, 11 days before this video, SpaceX stock hit an all-time low of $104.83, nearly 50% below its post-IPO high, after a brutal 7 weeks of trading. A company that made one person the richest man who has ever lived, in a single afternoon, watched half that value evaporate within 2 months. That swing is the entire story of this company. Understand it and you understand Starlink. Miss it and you'll think you're looking at a rocket company that happens to sell internet, when you're actually looking at a satellite internet company, quietly financing 2 of the most expensive science projects on Earth. Let's talk about what SpaceX's own IPO filing actually revealed, because the numbers are genuinely surprising. SpaceX operates 3 segments: Space, the rockets, Falcon 9, and the Starship program, posted a $657 million operating loss in 2025, driven mostly by Starship development. AI, the Grok and xAI operations absorbed into SpaceX in a February 2026 merger, burned $6.4 billion building out data center infrastructure. And connectivity, anchored entirely by Starlink, generated $11.4 billion in revenue in 2025, with $4.4 billion in operating income and a 63% EBITDA margin, margins that look more like a software company than a hardware business. Here's the sentence that should genuinely surprise you. Starlink is the only one of SpaceX's 3 segments that makes money. The rockets that made Musk famous lose money. The AI business burns billions. The satellite internet service is carrying the entire $2 trillion plus valuation on its back. So before you conclude you understand this business, you need to understand how Starlink actually grew into that position. Starlink launched in beta with 10,000 users in 2021. By the end of 2023, it had 2.3 million subscribers. By the end of 2024, that had roughly doubled to 4.4 million. By the end of 2025, it had doubled again to somewhere around 9 million. By March of 2026, the number had climbed past 10.3 million subscribers across 164 countries, served by more than 9,600 active satellites, roughly 75% of every actively maneuverable satellite currently in orbit around Earth. That's not incremental growth. That's a satellite constellation that scaled from a beta test to the dominant force in an entire industry in under 5 years. But here's the part almost nobody outside the industry understands about why that growth was even possible, and it's the single most important structural fact in this entire script. Starlink doesn't buy rocket launches. SpaceX owns the rockets. Every other satellite internet operator on Earth has to pay a third party, Arianespace, United Launch Alliance, whoever will fly their payload, market rate for every single launch, with no control over that cost and no ability to improve it through volume the way SpaceX can with its own reusable Falcon 9 fleet. That single structural difference is the reason Starlink's unit economics work when almost every other satellite broadband company in history has struggled or outright failed to make theirs work. Now, what does it actually cost to compete in this business? Building and maintaining a global satellite constellation at Starlink's scale requires launching thousands of satellites, each with a limited operational lifespan, requiring continuous replacement, funded by billions in ongoing capital expenditure that never really stops, because a satellite constellation isn't a one-time build the way a fiber network is. It's a permanently depreciating asset you have to keep replenishing from orbit. Layer on international market entry, securing landing rights and regulatory approval separately in each of those 164 countries, each with its own spectrum rules, ownership requirements, and political considerations. And you get a business where the marketing pitch is global coverage, but the operational reality is closer to 164 separate regulatory negotiations happening simultaneously, forever. Here's the structural mechanism that shapes almost every dollar of Starlink's regulatory cost structure: FCC spectrum authorization and interference coordination. In January 2026, The FCC approved 7,500 additional Starlink Gen 2 satellites and granted SpaceX a waiver to exceed legacy interference limits for its constellation within the United States. A genuinely significant regulatory win that competitors have to fight for satellite by satellite, license by license, in a process that can take years and has no guaranteed outcome. Spectrum for satellite constellations works the same way it does for terrestrial wireless carriers. It's scarce, it's contested, and losing a regulatory fight doesn't just cost money. It can mean the difference between deploying a competitive network and watching a competitor deploy one instead. Now here's the trap inside the trap, and it's not a hypothetical. It's a real company that lived through it. Meet OneWeb. In March of 2020, OneWeb, a well-funded satellite internet startup backed by SoftBank, Qualcomm, and Airbus, having raised $3.3 billion in equity and debt, filed for Chapter 11 bankruptcy after SoftBank refused its request for additional funding during the early weeks of the COVID pandemic. At the time of filing, OneWeb had launched just 74 of its planned 650 satellites. It listed $2.1 billion in total liabilities, including $1.7 billion in senior secured financing, owed to somewhere between 1,000 and 5,000 creditors. And here's the detail that connects directly back to the structural point about owning your own rockets. OneWeb's largest unsecured creditor was Arianespace, the launch services company OneWeb depended on to actually get its satellites into orbit, owed $238 million. OneWeb laid off 85% of its 531 employees before the filing was even announced. The company eventually emerged from bankruptcy in October 2020, sold to a consortium led by the UK government and Bharti Global for just over $1 billion, a fraction of the $3.3 billion originally invested, and years later merged into Eutelsat. So how does a company with $3.3 billion in funding from some of the most sophisticated investors on Earth end up in bankruptcy court after launching barely 10% of its planned constellation? The answer isn't that satellite internet was a bad idea. Starlink's own numbers prove the demand was real. The answer is structural. OneWeb was building a capital-intensive satellite constellation while renting the single most expensive input in that business, launch capacity, from third parties at market rates it couldn't control, at the exact moment a global pandemic made raising the next round of funding impossible. Starlink was building the identical kind of asset using rockets it already owned, at a marginal launch cost a fraction of what OneWeb was paying Arianespace satellite by satellite. It's the exact same industry, the exact same technology category, separated by one structural decision made years before either company's crisis moment arrived, whether you own the thing that gets you to orbit, or you rent it. That structural advantage explains why Starlink succeeded where OneWeb nearly didn't. It does not mean Starlink is immune to its own version of the same risk, and this is worth understanding clearly. Starlink's next generation of growth depends on V3 satellites, each one capable of roughly 1 terabit per second of downlink throughput, compared to 80 gigabits on the current V2 Mini, technology that fundamentally changes the network's economics. Here's the catch. V3 satellites are too large to launch on Falcon 9. They require Starship, the same next-generation rocket that's currently sitting inside SpaceX's loss-making space segment, still working toward its first commercial payload, targeted for the second half of 2026. In other words, Starlink's own future growth curve is now dependent on the very division of the company that's losing money and hasn't yet proven it can fly commercial payloads reliably. The company that avoided OneWeb's fate by owning its own rockets has, in its next chapter, made its most profitable business dependent on a rocket that doesn't exist in operational form yet. Meanwhile, the competitive landscape that looked wide open in 2021 is closing fast. Amazon's Kuiper constellation has launched more than 300 satellites, working toward a planned network of roughly 7,700. Blue Origin has announced plans to deploy around 5,400 satellites starting in the fourth quarter of 2027. Eutelsat's OneWeb, the same company that nearly died in 2020, now operates more than 600 satellites as a genuine surviving competitor. And in response to intensifying competition and the reality of a maturing subscriber base, Starlink raised prices on every consumer plan by $5 to $10 a month in May of 2026. A clear signal the company is shifting from pure subscriber growth toward extracting more revenue from the customers it already has, even as ARPU, average revenue per user, has fallen from $91 to roughly $81 as the subscriber mix shifts toward lower-cost residential plans in more price-sensitive markets. So who actually captures the value in a business built this way? Right now, almost entirely Elon Musk and SpaceX's early institutional investors. Musk himself held a 48.4% stake as of a regulatory filing in June 2026, a position that made him a trillionaire on paper the moment the stock opened, and one that swings by tens of billions of dollars with every point the stock moves. Public shareholders who bought at the $135 IPO price experienced both a 19% first-day gain and weeks later a nearly 50% drawdown to that August 3rd low, a volatility profile that tells you the market itself hasn't decided whether this is a software margin subscription business or a capital-intensive science experiment wearing a software company's valuation multiple. Now let's run the numbers two ways, because seeing them side by side is more convincing than any warning I could give you. The optimistic scenario. Starship reaches reliable commercial operation on schedule in the second half of 2026. V3 satellites begin deployment. Connectivity segment revenue continues its trajectory toward a projected $20 billion for the year, with EBITDA margins holding near 63%. And that segment's cash flow increasingly funds space and AI toward their own eventual profitability, instead of draining Starlink's margin indefinitely. In that world, the IPO valuation gets justified by a genuinely rare business, a capital-intensive infrastructure company earning software company margins, expanding into direct-to-sell, enterprise, maritime and aviation contracts carrying ARPU 10 to 50 times higher than a discounted residential plan. The realistic scenario. Starship development runs into the kind of delays that have characterized every major rocket program in history, including SpaceX's own. ARPU keeps compressing as Amazon Kuiper and a resurgent Eutelsat OneWeb compete harder for the same subscribers. And the AI segment's spending pace, already $6.4 billion in a single year, continues outrunning the revenue it's generating. In that world, the single profitable division keeps subsidizing two extremely expensive, not yet profitable bets, and the stock's first 2 months' volatility, swinging from a $2.2 trillion high to a sub-$105 low, becomes not a one-time IPO overreaction, but the ongoing verdict of a market still deciding whether that subsidy relationship is sustainable. So what's the real lesson behind a company like Starlink? It isn't that satellite internet is a good or bad business in the abstract. OneWeb and Starlink prove it can be either, built on the exact same core technology, separated by one structural decision about who owns the rockets. The lesson is that even the single most successful division inside the largest IPO in history is still, underneath the trillion-dollar valuation and the record-breaking debut, a subscription business whose margins are currently financing two capital-hungry bets that haven't yet proven themselves, one of which its own next generation of growth now depends on. Every number in this script, the $4.4 billion in Starlink operating income carrying a company that lost money overall, the $238 million OneWeb owed a launch provider it never should have had to pay retail rates to, the V3 satellites that need a rocket that doesn't operationally exist yet, exists for one reason. It shows that owning the infrastructure underneath your business isn't just a cost-saving detail. It's frequently the entire difference between the company that survives its crisis moment and the one that ends up as somebody else's much cheaper acquisition. The satellites, the subscribers, and the trillion-dollar valuation are the easy part to see. What actually determines whether Starlink is still the exception in 10 years, or becomes a cautionary tale told at a scale nobody's ever seen before, was never how many satellites it launched. It was whether the one profitable part of the business could keep outrunning what the other two parts were spending to chase it.